Hi, guys, and my name is Thaon Simms. Welcome to the Limitless Podcast. Joining us as always is your co host, Dr. Matthew Preston. Hail up the people, and Matthew.
Hey guys, what's good?
Perfect. And from the title of this episode, you guys already know we're in the Dividend series bag. So we'll be talking about today, we'll be just discussing, I guess, some capital gains versus dividends. Which one is better for you? Which one is right for you as an investor? Just talking about maybe some of the pros and cons of both. Didn't really come up with a presentation. We're kind of just going to do it on the fly. But hope you guys enjoy this one because this has been a contentious argument for years, hasn't it, Preston?
Mm-hmm.
I think there's a lot of, I guess, discourse, debate, healthy discourse, I would say, on just the perks of both. Like, what are the perks of, investing for capital gains? What are the perks of investing for dividends? Some people love and defend dividends, right? Big up to the other finance YouTubers that are out there that, preach dividends and so on. Dividends, not so much for me. I have invested for dividends in the past. And we did speak about, investing for dividends in the past in our previous episodes. So you can check out the previous episodes in the series. But today we're just going to be talking about it in context and contrasting capital gains, right? And which one looks nicer, which one is safer, which one is sexier, all of those kind of stuff. So let's jump right into it. So, Preston, are you a cap gains man or a dividends man?
Cap gains, team cap gains.
Team cap gains.
With a
What's
dividend
cap
here or
gains?
there.
What's capital gains? Like, if just for the layman, how would you describe what capital gains is?
So you buy something for a cheaper price than you sell it at. So whether it's a stock, a house, a bond, or whatever. Say you buy a house for 10 million and you sell it for 20 million. The capital gains or basically the net profit that you'd make from that. So I guess you can't have some fees and whatever. But if you buy it for 10, sell it for 20, you make that 10 profit there. And where there's a stock, you buy it for $10, selling it for 20, making $10 profit there. So it's just the price difference between where you buy it and sell it at.
And dividends, of course, that's what we've been speaking about, the company or the stock. Let's say you own a stock, right? And you get a portion of, let's say profits for simplicity, a portion of the retained earnings or the profits is paid out to shareholders as a dividend. So that's literally what a dividend is. So it's basically just a company paying you a portion of their profits, in very simple terms. But which is better for the investor, right? That's always key because other people would invest for dividends, other people invest for capital gains. Why do you invest for capital gains?
I think it's just suits my goals right now. If you look at, if I was just investing for the dividend alone, I guess I could say on the JSE, Jamaica Stock Exchange, I don't know what the highest dividend yield right now is, but maybe it's like 5% or maybe 6%. Or I guess it depends on what price you get it at. But if it's the price that I could get it at the time, maybe 5%, maybe even some technically maybe I could have hit as high as 10% depending on what price you get it at. But if it was just the dividend alone and then I didn't see any appreciation in the stock price, like or any possible cap gains, the 10% I don't think is really enough for me, So I would want more than that. So if the only thing is, if there's a dividend stock, yes, it could pay me the 10% dividend, but if I don't see the stock price appreciating by an amount that would justify it, like say 20%, 30%, 50%, 100%, then I don't think it really makes sense for me,
No, fully understood. And those are you brought up two very important points with capital gains because one, yes, you do tend to have a higher upside potential when you compare it to dividends because the stock can increase even over 100%, right? If possible, and it's hard to ever see a dividend over that. And then of course, there's no limit to how much the stock price can rise in reality. And that's as I said, can rise, possibility. It can also go the other way, right?
But there's
And
a
you
limit to
can't
how low
pay.
it can go.
There is a limit. Yeah, it can approach zero, but never actually hitting there, right? But the other thing though is, well, you can't get a negative dividend. Like they can't take money back from you. But the stock price can fall and you can lose money on the trade. So, there's always that. That's why people say capital gains are risky, right? Much riskier than dividends. That's the general consensus. But in our previous episodes, we also spoke about dividends not being guaranteed, right? And we've seen that in the past. There are a ton of companies on the Jamaica Stock Exchange that, used to pay even quarterly dividends and may not be paying dividends now, or paying like just one dividend for the year. So that's something that even in IPOs, in the last IPO, I think Atlantic or so on, or even in Trans Jamaica Highway, if you look in the prospectus, there's always a dividend policy, and they state how much dividends, like how much they'll pay out in dividends, and it's always usually stated as a percentage of net profits. But if you notice the language, it's always up to, right, a maximum of like 50% of net profits can be paid out to dividends. But would a company do pay all of that if they have other obligations and so on for the cash? Probably not, right? A wise CEO would not do that. A wise company would not pay out a dividend when they don't need to and when they have other obligations for the cash. So dividends are not guaranteed. That's another point that that people think, because some companies, people used to, like NCB. Let's give an example for NCB. NCB prior to COVID used to pay regular dividends, right? I'm not sure if it was quarterly. I feel like it was quarterly dividends they used to pay. That used to be some people's cash cow, right? That used to provide regular income for people. And that was a great investment strategy, right? A company's been paying quarterly dividends for years, right? This is probably your pension. You probably have millions in NCB, so you're probably getting a good chunk. Let's say you could be making somebody's salary off of a quarterly dividend. Every quarter you make somebody's salary, right? Or you make your old salary. But imagine now when dividends have dried up, right? Or it's not guaranteed. It's not regular cash flow. But capital gains is a bit different because you don't make the money until you actually sell the stock, right? And so you made a good point where you said you don't invest. You invest in capital gains because that suits your goal, and that ties in with our investment philosophy where you have to do it for your own goal. It's your own personal goal, right? If you want to make 10%, or if you want to make 5% off this investment, right? And you see a dividend, you don't mind holding for 2 years. 5% in 2 years, you can find dividends that pay 5% in 2 years. Companies that pay 5% in 2 years in dividends. You can also find capital gains too, as well. So it's very dependent on your goal. You also mentioned a very important point, and we spoke about this when we were looking through some of the comments on our YouTube. Guys, we read all the comments, trust me. So we'd love for you to leave all your comments. But you said fees. You're talking about fees earlier, and the fact that I think the beautiful part about investing in on the JSE is we don't have capital gains tax, because in America you're taxed. Like if you buy and sell a stock and you make a percentage gain, that actually is a bit less because you have a tax on the money you've made. Whereas in Jamaica, you don't have that. You do have, though, a percentage based on each trade. So you do have, when you buy a stock, there's a small fee that goes to, there's there's JCSD, there's GCT on that, and so on. And then the broker also takes a cut. So I know when I'm buying or selling a stock, if I'm using, I know Sagicor, I think, and JMMB have 0.5% as their broker fees.
Mm-hmm.
I believe it's 0.5% per trade. I think those are the lowest in the industry.
Yeah,
right?
I'd love to someone to go 0%.
Yeah. If you go 0%, I'm there. I'm there.
Mm-hmm. That's all. It's over.
It's over. Yeah, they're literally win. That's an easy recommendation to everybody. And so if you
Mm-hmm.
buy the stock, you have to pay a percentage. And with the other fees, it amounts to about 1%. So every time you buy a stock, that's 1%. Every time you sell a stock, it's about 1%. I use both Sagicor and JMMB to trade with. There, I also have other brokerage, but I use brokerage houses with smaller fees. If I'm doing a lot of trades, if I'm buying and holding, I'll use something with it doesn't really matter the percentage because I'm not buying and selling, so it's not a lot of fees that are being taken. However, dividends, there's also a fee. You realize that? And I think a lot of people may not realize that too. And that's something a lot of big name investors, I'm hinting at Chris Berry, has called the government out on. And that's the 15% dividend tax. Because your dividends are taxed. Right? It's 15% withholding tax in Jamaica. So let's say a company is paying $1 per share in dividends, right? And you own 1,000 shares. You're actually not getting $1,000. You're getting 15% less of that. So that's about $850. And that's a dividend tax in Jamaica. And it's kind of, I get why they want to change it, because that's a lot of tax still when you think about it. Imagine buying the stock, you have to pay some level of tax. The company itself, all right, take it from the company standpoint. I'm paying, let's say I am Trans Jamaica Highway and I make some profits, right? I make a ton of profits. For argument's sake, I make $1 million US in profits, right? But that's before tax. Now, I am, if you're not on the junior market, then you have to pay full corporate income tax, which is 25%. So you've already taken off 25% off of that, and you're left with a figure. Then now, if I want to pay this as a dividend to shareholders, I also have to take 15% off of that profit and pay the government that 15% as a tax, and then the shareholders get that. So you're taxed twice when you think about it like that. And so I get why it should be abolished, because then, I mean, yes, the rich earn, but the poor also earn too if you're investing for dividends. We all earn. So I was hoping in the budget we'd hear something about that. Guess we didn't. It is what it is, but we'd love to see when that dividend tax drops. Drop it to 10%, drop it to 5%, drop it to 0%. I would love to see some progress there. But me personally, I don't know about anybody else, guys. If you're in the comments, if you're watching this and you want the dividend tax to be gone, just comment down below. Right? No dividend tax. Yeah.
I
But
think
there's
there
no
was,
capital gains tax.
wasn't it teased or something? I think the
Boy.
government said, let me pull up this article. This was written by David Rose in the Observer. Prime Minister teases cut in withholding tax on dividends. To Jamaica. Yeah, said
I don't like anything that name tease, bro.
15%. Hold on, the current withholding tax rate stands at 15%. I can't say too much at this time, but we are exploring a reduction in the rate of tax on dividends. This was at the Jamaica Stock Exchange conference.
I actually remember this. Yeah.
It was actually put in 2013. Interested. I don't know what was the tax before. Okay, so because I mean, the Prime Minister's talk is next week. He gives a talk, so yeah, maybe you can look out for there.
Maybe
The whole budget stuff. So yeah.
Yeah. I mean, by the time this episode comes out, we'd have already known. This is recording March 12th, so we haven't really heard everything. But let's see. Let's actually see. Yeah, but you want us? Let's probably look at some examples of companies that pay good dividends as well as possible cap gains, and let's see the difference. Pick a company, Preston. Any company. A company that pays good dividends.
I think one of the best examples would be Carreras.
All right, let's go to Carreras.
Yeah, so let's see, how much did they pay out in the last? Okay, so based on the current price, which is 15.76, their dividend yield last year, or 2024, was 6.48%. Yeah, that's
6%. That's pretty good at that price.
Yeah, because that's the thing. It's at $15, and
that's over the year.
Yeah, so that's the thing. Like it started 2024 at like $9. So if you even work out, yeah, that yield is pretty high. Yeah.
Let's compare it to the capital gains aspect. So you said what percent? Sorry.
6.48%
at a price of 15. So let's take it a year back. Let's say you invested Carreras 1 year ago, right? So today is March 12. Let's take today closed at 15.76. Let's say you went back in time to March 12 last year. March 12 last year, the price was
76.
It closed at
or
$8.52. $8.52 till now is 77% in terms of capital gains. And what would the yield be at this price at $8.52?
Might have to hold on.
Yeah, you may have to do some actual math, but you said 76%. Wow.
Which price is it? I should use
$8.52.
$8.50. So $1 to $8.52. That's at 12%, 11.9 or 12% dividend yield. Yeah.
All right. So both of those figures look actually absolutely amazing. Right. In terms of like a dividend at that price is at 12% yield dividend is very high. It's the highest in Jamaica actually. On the Jamaica
People
Stock Exchange.
love their cigarettes.
Yeah. Yeah, people do love their cigarettes. But that capital gains is undeniable as well. Right. So imagine investing a year ago at $8.52. Not only would you have reaped that 12% in a year, but you also reap that 70% percent. So, Carreras is a great example because you get the best of the both worlds, right? You get that nice dividend where you don't have to sell the stock, and you get that wicked cap gains where you're up 76%, you said? Beautiful. Well, you chose a great stock. You literally chose a great stock. So, yeah. Another company I know that pays good dividends is actually Dolphin Cove. So Dolphin Cove pays really good dividends as well. Not as good as Carreras, but they're pretty up there. And they are pretty regular as well. Since tourism has just been booming. Oh, they dropped today. 17.23. I mean, they've been You know, there's been a nice like a fluctuation in terms of price recently, and that's because of the parent company announcing bankruptcy, which is kind of nice for investors to trade this. The astute investor, I should say. But let's do the same thing, right? We're looking at Dolphin Cove 1 year ago. So 1 year ago, the price Dolphin Cove March 12 was
1991. Yeah, basically $20.
19. Okay, basically $20. 1991. And today it's 1723. So you'd have lost a little bit in terms of capital, well, capital depreciation instead of appreciation. So you'd have lost some funds. I'm actually not doing the math right now. I should probably do the math. Or unless you're doing the math.
No, hold on, I was doing something.
But so in terms of cap gains, well, you wouldn't have made money if you bought at that price a year ago. But when you look at the yield, right? The current yield, let me find dividends. 2024 is $1.20 that they paid out last year, and they paid a dividend in Q1 and Q2. So I actually need my phone to. I don't really want to do it on my laptop because the clicking.
What is it you're trying to work out? The dividends I paid for 2024?
Yeah, I wanted the yield.
$1.20. To which price you're working on? 20?
That you bought it at, yeah. So call it 20.
That's 6%.
6%. 6% is not bad. It's not a 12% like Carreras, but the price did fall recently. And big up to everybody that got it at this trough. Let's work it out for this trough. Like, let's say you're trading this and you see it dropping and you buy it. Well, the lowest point, it closed at $12.41 on February 27th, 2025. But let's say you're buying it at let's say you bought it at this price, right? $12.41. What would the yield be at $12.41?
So
1.2 and $12.41. That's closer to 10%. That's about a 10% yield.
Yeah, just under 10%.
And then imagine the capital gains now because it's at 1723. So 1241, 1723. You'd have been
and the
up.
sell queue is at like 19. So if anyone wants to buy,
they have to buy at 19. And Dolphin Cove has been printing money. They've been making good profits. Tourism arrivals have been decent.
Well, the profits have actually been.
They've dipped. They have dipped for sure. Especially the last quarter, the profits dipped tremendously.
Well, wait till the fourth quarter.
Yeah, the fourth quarter is always, Fourth quarter Dolphin Cove is always very interesting, isn't it? Yeah. Yeah, that quarter has always been. It's usually a loss. But yeah, these are some really good examples on the JSC of, companies that pay decent dividends. Because imagine if you bought this a year ago, you'd have been down in terms of capital gains, but you'd have made like 6% in terms of dividends. Now, you also have to be thinking about, still use Dolphin Cove as an example, right? 6% dividend. If you had $100,000, what would that actually translate to? Like, how much dividends would you actually earn? Because I find that that's something that people don't really take into account, like, yes, everybody likes to hear dividends and wants to invest for dividends and so on, but what does 6% dividend yield actually look like? Like, if you were to get 6% on 100,000, 6% of 100,000 is 6,000 Jamaican dollars. And then remember, the dividend tax is 15%. So you have to multiply that by 0.85. What's 15% less of 6,000 Jamaican dollars?
5,100.
5,000.
Yeah, 5,000.
5,100. So 5,000. I mean, it's 5,000 more than you never had before. But you'd have also lost money because you bought at like 20 and it's now trading at 17.23 or 19. So it's something to consider depending on the stock you're buying, because you could be in it for dividends, but you also have to be medsing the stock price. Because yes, it could pay good dividends, but if the stock price is falling, suppose the stock price falls like it did with Dolphin Cove, and it was something very material and it would stay at that lower level range, like $12, right? And you bought at 20. That means you'd have lost that would have been what percentage loss? 12, that's 8. 8 divided 20. I don't know. I can't math right now off the top of my head, but you'd have lost a decent bit of money. Right? You're looking at maybe a 40% loss. I can't do the math off the top of my head. Maybe about a 40% loss. Yeah. And you'd have just made a 6% dividend. So the 6% dividend doesn't really, help with that 40% loss. So it's always really good to still think about the company you're invested in. Yes, they have a previous history of paying really good dividends. But how's the company doing? Will they continue to pay?
Is that you said a point earlier where I think you said that, okay, some people view investing for dividends as less risky. But what I would say is that it could be less risky sometimes, but it isn't always less risky. It doesn't have to. It's not just, oh, I'm a dividend investor, I don't have to, because as you pointed out, like the company, certain things have to happen for them to be able to pay a dividend. They have to be generating profit, and a lot of that profit has to be backed by cash, because the dividend is a cash payment. So the same things you would do to analyze a company, to say, okay, this company is actually, valuable and they're gonna grow, their profit is gonna grow, their cash is gonna grow. Those same things that could, for example, lead to increase in the share price could also lead to an increase in the dividends. But then, like, you can't just, buy, this company has been paying dividends for 4 years or 10 years, 20 years. I'm going to buy it because it's been paying. Like, that alone, I don't think is a good enough reason. Like, that could be one factor in determining that you're going to pick it as a dividend investor, but that should not be the only factor. Because just because, like, it's something that you realize that just because is a thing that we have with people that, because something has been going on for a while, or because this company has recording profits, things are going good, we start to like think that, things will kind of go on good for a while. And it doesn't.
You start to fantasize, You see in the
not
box.
always like that.
Yeah. Good talk. Yeah, you really still have to do your research and look into the company. And you're right, as you said, dividends are backed by cash. Are the profits cash profits, or is it like revaluation on property and other things that is not really cash related? So looking at you look at the cash flow statement sometimes in our analysis, which is key. Like you have to look at how is the cash moving, because just looking at profit in isolation can be misleading, can definitely be misleading. So yeah, but these are a couple good examples of dividends, dividend paying stocks on the JSE, and how they match up with cap gains as well. So I think that's really it for this episode, guys. If you liked it, If you want to hear more about dividends, if you want us to talk anything more, if you like it, right, leave a like. If you love it, subscribe. We'd love that because we're aiming for 5K by the end of this year. So thank you guys so much. And Limitless out.
Peace.